If you've been watching the stock market for the last few decades, you probably think of Johnson & Johnson as the ultimate safety stock, a steady giant, a company you buy for dividends, not for explosive growth. But if we look closely at the financial reports from 2024 and the quarterly earnings throughout 2025, a different picture begins to emerge. We are witnessing a fundamental transformation. The Johnson & Johnson of today is not the same company it was 5 years ago. It is leaner, more aggressive, and entirely focused on high-tech, high-growth sectors. Today we are going to walk through exactly how this 140-year-old company is re-engineering itself for the future, analyzing their latest financial data, their massive strategic pivots, and the specific drugs and technologies that are poised to drive their revenue through 2030. To understand where Johnson & Johnson is going, we first have to understand what they have left behind. The most visible change was the separation of Kenvue, their consumer health business. That means Tylenol, Listerine, and Band-Aid are no longer part of the core growth engine. But the transformation didn't stop there. In the third quarter of 2025, management announced their intent to separate the orthopedics business. This is a crucial detail that many casual investors might miss. Orthopedics has historically been a slower growth, commoditized market. By planning to exit this space, J&J is making a clear statement. They are shedding the weight that slows them down to focus exclusively on their two highest-performing engines, innovative medicine and high-growth MedTech. Let's start by analyzing the innovative medicine engine, which is arguably the most critical driver of their future cash flow. The data from the first 3 quarters of 2025 shows a clear trend. The company is successfully navigating a patent cliff and replacing it with next-generation blockbusters. For years, investors worried about the loss of exclusivity for Stelara, a major immunology drug. The 2025 reports confirm that while Stelara revenue is facing headwinds from biosimilars, the gap is being filled and exceeded by newer assets. The star of the show here is Oncology. The financial results highlight Darzalex as an absolute juggernaut in the treatment of multiple myeloma, with sales continuing to grow at double-digit rates globally. But the future isn't just about established drugs. It is about the pipeline. In 2024 and 2025, we saw the rise of Carvykti, a cell therapy that reprograms the body's own immune system to fight cancer. The production capacity for Carvykti has been expanding, addressing a massive backlog of demand. Furthermore, the lung cancer portfolio is being revolutionized by the combination of Rybrevant and Lascluze. Clinical data presented in 2025 showed this combination offers a survival benefit over the current standard of care, positioning it to become a primary treatment option globally. Moving beyond cancer, let's look at immunology and neuroscience. In immunology, Tremfya is the key player. It is not just maintaining market share. It is growing by expanding into new indications like inflammatory bowel disease. Then there is the pipeline asset icotrokinra, an oral peptide for psoriasis. This is a potential game-changer because it offers the efficacy of a biologic injection in the convenient form of a pill. In neuroscience, Spravato has broken the mold for treating depression, showing strong uptake and reaching blockbuster status. Additionally, the acquisition of intracellular therapies has bolstered their portfolio with Caplyta, adding immediate revenue and a foothold in treating major depressive disorders. Now, let's pivot to the second engine, MedTech. This segment is undergoing a radical shift toward high-tech intervention. The acquisitions of Abiomed and Shockwave Medical have fundamentally altered the profile of this business. They are no longer just making surgical tools. They are dominating the cardiovascular space. The heart recovery pumps from Abiomed and the intravascular lithotripsy technology from Shockwave, which uses sonic waves to break up calcium in arteries, are high-margin, high-growth products that have virtually no generic competition. Perhaps the most exciting development in MedTech is in robotics. For years, the market has been waiting for J&J to answer the dominance of competitors in surgical robotics. In 2025, we saw significant progress with the Ottava system. They have secured investigational approval to begin clinical trials in the US. Ottava is designed to be more flexible and take up less space than current systems, which could be a major selling point for crowded hospital operating rooms. If J&J can successfully commercialize Ottava, it opens up a new multi-billion-dollar revenue stream that will last for decades. Financially, the company remains a fortress, but a growing one. Throughout the first 3 quarters of 2025, We saw operational sales growth consistently hitting the mid-single digits, with adjusted earnings per share following suit. In the third quarter of 2025 alone, worldwide sales reached $24 billion, up 6.8% globally. This isn't the stagnation of an old conglomerate. It is the steady acceleration of a focused biopharmaceutical and MedTech leader. They are generating massive free cash flow projected around $14 billion for late 2025, which allows them to fund these massive R&D projects and acquisitions without putting the balance sheet at risk. So what is the verdict for the long-term investor? Johnson & Johnson is successfully executing a two-sector strategy. By focusing on huge unmet needs like cancer, heart failure, and robotic surgery, they are insulating themselves from economic downturns. People need these treatments regardless of interest rates or inflation. The planned exit from Orthopaedics further purifies this thesis, leaving a company that is faster, more innovative, and higher margin. While no investment is without risk, regulatory changes and drug pricing pressures in the US are always a factor. The J of 2025 is built for endurance and growth. It is a rare combination of the safety of a blue-chip stock with the technological upside of a biotech growth play.